From one retail investor to another. This is Trader72. Welcome back to my YouTube channel on this early part of the week. We are back. I hope you had a tremendous weekend, all of you. I know I didn't again do much, watched quite a few bit of golf this weekend, the PGA. For some of you that hate golf, I'm sure you'll ignore that comment and probably fast forward this bit. For some of you who do, well, it was interesting, and we have a new winner as well this week. An Englishman winning the PGA as well, which is great, without sounding too nationalistic, but it is what it is, so we were pleased for the winner. But anyway, without further ado, we are back, and I'm going to change it up a bit this week. Normally we do analysis. We've done a few last week. We're going to change it up today. We are basically going to we're going to have a look at my watch list. Now, these, out of all of them, only one I've invested in at the moment. All the others are, as I said, on the watch list, ready to be looked at and pounced on, so to speak, in terms of investment. Strong companies with strong moats, big cash flow, long-term standing on the upside. No hype, no penny stocks. High quality names I'm watching closely at the moment for potential bargain entries. And again, as some of you may know by now, all based on a intrinsic price, the true worth price. Remember, guys, there is a famous quote: in the short term, the market is a voting machine, and in the long term, it's a weighing machine, by Benjamin Graham. And in no truer words than chasing the hype short term is, always the way that obviously the market goes, as opposed to value investors who are not chasing that and obviously chasing the long run, which obviously in the end will be a winning strategy. Now, in terms of contradiction, I tend to buy in a company, and if I feel it's right to sell quite quickly, I do, depending on cash flow. I am not a multi-millionaire, so, cash flow is cash flow at the end of the day, so I could hold a stock for a year, as I've done with Adobe at the moment, and some of them I might sell within 2-3 weeks or 6 months. It really depends on what I feel the entry point and strategy of the stock. Now, actually, when I said I only had one stock I own, actually I have two out of the potential 8 that I'm coming up with, as you can see from the intro graphics there. So without further ado, let's have a quick look at really my situation in terms of which companies I'm looking at, why I'm looking at them, and then potentially a little bit finish off with a bit of news and what we're looking forward to this week. Let's go and start this off. As we said here, my watch list. Now, we got Microsoft, S&P Global, Uber, Visa, Mastercard, Meta, ServiceNow, and Adobe. Now, I feel obviously a lot of these are under the tech name. Meta, obviously, specifically in Microsoft. We've got a couple of financials in S&P Global, Mastercard, and Visa, although S&P Global is more of a slightly different to the other two. The other two are obviously merchant cards. S&P Global more is credit, obviously ratings agency, as well as the S&P itself. Meta obviously more social media, and Adobe more creative services. So ServiceNow obviously more financial software. So there is a nice balance. I mean, obviously Uber, which I don't want to leave out as well. In terms of app and obviously taxis, freight, and delivery. So again, not maybe under the tech banner, but are all various different businesses that kind of have a great reach around the world. As you will see, these are pretty much established big companies that have been around, big caps, big moats, great management, most of them, and also a good understanding of what the business does, which I think, I repeat myself, is all important. And I think if you read, which I did, the Rule 1 book by Paul Town, obviously, it will mention the 4 M's, which I think is super important in terms of understanding a business. Once you qualify those 4 criteria, you are halfway there at looking at the company and potentially investing. Now, please, I'm going to put a little bit of a small intro there. I am not a financial advisor. I have no financial background, so therefore I am purely here as advisory. So please, guys, do make your own due diligence before buying in, not just on my say-so or my position with some of those stocks. I'm not here to influence anybody. I'm just here to advise. So please do bear that in mind. So let's start with the guys here. I mean, Microsoft would be obviously one of my top ones. So if we switch to Microsoft at the moment, we have down here on my chart. So these are all the charts of the companies I'm looking at the moment. Bar crude oil, which obviously is a position I have at the moment, so ignore that. But let's have a look at Microsoft. Microsoft at the moment, let's pull this up a little bit there, right in the middle. As you can see, I'm looking at a one-day chart because at the moment I'm looking at a medium-sized position if I was to buy it. Now, we know that in the past, looking at, and this is purely not about the company and about its numbers, I've pretty much done analysis on all of these companies above, so please do refer back to my list of companies I've analyzed. This is purely about the intrinsic price, the MOS, why it's on my watch list, and the fact and an entry point, and looking at the chart. So this is a little bit of a different angle to what I would normally do, which is an analysis of the company, the ecosystem, and the numbers. This is more about really where the stock and the share price is at, why I'm looking at them, and what potential entry point might be best in terms of support line or in that respect of, looking at when the stock is, on the 50-day moving average or a 200-day moving average. Now, clearly at the moment, Microsoft is sitting on a 50. As you can see, the green line here is a 50 at the moment. It's currently sitting at 420. And it has roughly an intrinsic price of 489. So it doesn't give you a huge amount of MOS. And I'm going to switch back here, guys, to the actual MOS itself. Looking there, we're looking at probably 15 to 6, pretty much 16% at the moment on MOS, currently at 419, maybe a little bit more because the share price moved since Friday. So Cloud Leader, we know what it is, strong recurring revenue, has been bashed recently for, obviously CapEx spending, and we know well-known facts. I'm not going to go into that again today. And it has gone down as far down as 380, where a few actually big investors have bought in. Now, I would suggest that at the moment 15% is one of the smallest of the margin safeties of all the companies I'm on my watch list, but it's a tremendous company that I think is going to be around for easily for the next 10-15 years. And at this moment, I think 420 might be a little bit of I mean, if you guys like the stock, obviously, and you're keen, it's still at a pretty much at a much more lower price than it has been on average for the past 2 or 3 years. We're around the 480 to 490 mark, currently at 419. So still worth potentially a buy. It sits just above the 50-day moving average. But as you can see there with my arrow here, it has fallen back as far back as 350, or on average around 362. If you're sitting on the 50-day moving average, you're looking at maybe under 400, which would be potentially a great buy. Now, my entry point for this, if there was to buy into Microsoft, would be probably around the 380 to 390 mark. Or if you wanted to maybe look at a 20% discount off its intrinsic price of 489, maybe even the 400 would probably be a good price to buy in. So that's where I sit on Microsoft in terms of entry points, but definitely one on my watch list at the moment, and really like the company. And I think that it has been, I think, unfairly and overdone in terms of the share price dropping because of this whole software replacement on AI and the CapEx spending, and the fact that obviously the OpenAI situation has obviously moved the needle down on Microsoft in terms of the association with that. Potentially no longer an association with them at the moment, or an exclusive deal. So things are looking up. I still don't think that you can ever replace the moat of Microsoft. So I think it's a pretty safe bet that Microsoft will eventually bounce back. So no doubt there on this one. Moving to S&P Global, which is one of my favorite stocks, 29% discount at 549 intrinsic price. Currently, no longer at 424. It is currently at 405. It has dropped back, and I bought in. This is one of the ones I bought in at the moment. I bought it at 408. Currently, about I bought a small amount of shares. Not too much. I think about £2,000 to £3,000 worth of shares. Dipping my toes in the water, so to speak, with S&P Global. I have bought in the past when I bought at 435 and came out with a small profit, but wished I'd bought it cheaper. When I got the opportunity to buy a 4A, I did. Now, clearly it has issues with obviously a sticky inflation. It is all related to that. Obviously, we know the nature of the business of S&P Global. It owns the S&P 500. It is a credit agency for companies as well as and issues bonds, etc., for companies in distress or needing leverage. It has an analytics business as well, and I think it's a fantastic business which is going to go from strength to strength. Again, slightly bashed by the SaaS apocalypse recently, potential replacement by AI agentic, but again, I'm not convinced by that. Well, certainly not convinced by that myself. Obviously, look into it, guys, yourself. So data analytics monopoly, and it has a huge monopoly with obviously the other company, which escapes my name, Moody's. Sorry, guys. So still early for me in the week. So currently, I think it's definitely worth a look at. 29% discount, almost 30, and I'm certainly looking at a very good entry point there, even now at 405, guys. Just above that, you could potentially wait maybe to go south of 400, maybe a 395, 380 would even be a better price. It has fallen back to 380. Back in end of March, where it fell back to, sorry guys, I'm just gonna back to 397. So we're pretty much near the bottom there, bottom end of the share price, maybe even nearer to a 52-week low, and I think this will eventually bounce back. Now, obviously, there is the company does work on interest rates and what's going on geopolitically as well. And it has definitely, and obviously the sticky inflation going up has affected that stock at the moment. But still, S&P Global is going to be around, a well-established company, great moat, great management, and a great understanding of the business, and I think to be there. So maybe a patient game on that one, which I'm going to probably look at. I'll probably be looking at very quick in and out of that one, maybe between 405 to maybe an exit point of 450, 440, 450 even. So that would be a tidy profit for me. Now, we got Uber, guys, which, I really like as a company, a global mobility platform involved in, obviously, a pickup app for taxis, obviously. It has a freight department as well, trucking side. It also has, obviously, Uber Delivery, sorry, one of their rivals. And, obviously, the robo-taxi situation associated with Lucid, putting the actual app or the actual software in the app itself and bringing those clients across, obviously billions of clients. They've got Uber One as well, also as a subscription as well, and I think for the first time in the past 4 or 5 years, actual free cash flow plus, not negative, which it has been. So Uber definitely up there as one of the companies. Again, surprisingly down on its share price at the moment. Not 97, it's currently now at $75 a share. Now, I'm quite surprised because they had some great numbers last time around. But it's just the stock seems to be in a bit of a rot at the moment around the $75 mark. Now, whether or not there is a lot of competition, but it is one of the biggest companies around. I can't see them disappearing, and I think there will be a massive play in terms of the expansion that they're going through at the moment. So I think they're still very much a bargain, and I still think they're around the 40% mark at 75, considering that the intrinsic price we're looking at here is 126, and that's been quite conservative. You could pop that up to maybe just under 150. So I think it's definitely worth a look. I think the entry point at the moment is probably about right now, 75. I would say that if you were going to be a bit more pedantic and a bit more sure that you can squeeze maximum profit from this trade, that 68 to $70 a share would be probably the better look. So yeah, definitely on my watch list. I think I would be looking at myself at 70, 72 before I bought back in, for sure. Now, moving on to two of the companies that are currently on my watch list. So looking at now Visa and Mastercard, we'll do them together, I suppose, as a joint chat there on this one, because obviously Visa and Mastercard are both from the same market, both merchant rail in terms of payment between obviously the buyer and the seller. Well established, huge moat, duopoly really, the duopoly as I call it, of the financial side of it. Yes, they're going through a bit of a bash at the moment. Again, the word bash comes into my chat quite a bit. Obviously, these are companies that are where they are for a reason. If they were at the top end, they wouldn't be on my watch list, obviously. Competition for credit cards, caps on interest rate we know about. So lots of issues going on with, crypto as well on top of it. So they have been a little bit wonky at the moment, Visa and Mastercard, and very much stuck in a price range. Both at the moment still bargains, I would have thought. Visa at 416, Mastercard at an intrinsic price of 671. Now Mastercard is currently not 19%. So I think now, because the share price has moved and it's not updated my share price, let's have a quick look at the actual current share price, because as we know, it's live, these share prices, they do move. Now currently Mastercard is at 492, guys. Let's pull this off again, put them above each other there. Oops. So again, as you can see there, Mastercard at the moment 492, which gives it a 26% discount at the moment based on the 671, and Visa currently at 325 is currently at a I've just forgotten, Visa at 416, so which is just on the around the 20% discount. So not quite in my criteria that I would look at, because there is not just about the entry point on the chart, it's also about the intrinsic price and the MOS. If the MOS is under 25%, I still want a bit more safety above 25. That's my minimum criteria. So anything above that, then it's just, depending on the matching of the actual share price and the company and what it's doing at this current moment, and what pros and cons are against it, that makes it certainly more interesting for sure, because the higher the MOS, the less you get hurt if it falls through, or if there's any issues. So again, both of them I would be looking, Visa I would be looking at no less than probably about $300 a share, which is where I've bought in the past and sold quite quickly a couple of weeks ago. It's more of a defense stock in a way, Visa, than Mastercard. Mastercard is certainly a bit more lively in terms of beta, and Visa is more of a slow compounder. Both are compounders, but Mastercard is more of a jumpy stock. So is the difference between where the stock moves depending on the market. So if anything above 1, let's say 1.5, it means that that stock will move by 1.5 further than the actual index itself. So if the index is losing 1%, it looks like the stock will lose 1.5 on top. So there is a bit more movement on Mastercard, which I think if you want to be more of a short-term trader, is probably a better option. Currently both momentums, because I go on Stoich and MACD here, I like that because I think it gives you more of an idea of a momentum than the RSI. Currently at the moment in oversold territory, so going absolutely nowhere at the moment, Visa, Mastercard. If you want to go in and out quickly, you're looking at a range of between 490 to 525. So 490 would be where I would potentially look at buying into Mastercard, and Visa I think anything around $295 to $300 a share. So currently 325 is probably more on my watch list in terms of intrinsic price and entry point on the actual share. The momentum looks like it's kind of flatlining above 50, so not bad there, and you can see the buying has increased as opposed to Mastercard, which didn't have the same numbers as Visa, I think, on the last release, because Visa's last quarter trading update was very, very good, and Mastercard wasn't quite, so it did get punished. But at the end of the day, both will be around. Absolutely for sure. They are too well entrenched in the global market, the financial global market, to be literally taken out and be a thing of tomorrow. That's my opinion. So that's for these two. Now, moving on to Meta. Again, well documented, did the analysis on Meta recently. Massive user base, obviously Facebook, and so forth. Very, very much in terms of, moving up in terms of ad, which that make most of their money on their sites. And Meta has been a success story in the past few years, or come back from the dead, really, from 2022, when it was losing market share. Now, it has reached a peak again. It's spending an absolute fortune again on capex, well documented again, so please refer to that if you don't know much about it, or again through one of my analysis in my playlists next to me somewhere here. And that's me being clever, which didn't quite work out because I had no idea which way the playlist is, but hey. So at the moment, the intrinsic price is 823, quite conservative, certainly in a nice ballpark at the moment. Meta as a stock is currently at 609, so you're probably looking just under 25% discount. Great price to buy in now if you were. I mean, you know, obviously we know that back in March it dropped as far back as 518, so quite a drop. So my entry point really for me would be probably anything below 600 to be absolutely sure you're buying at the right price and getting a nice move up. The momentum has pushed up on the one-day chart. And actually hasn't. It's actually flatlined again. Let's have a look at the 1 week chart, which obviously the overall, if you're looking at more of a long-term investor, kind of flatlining at 50 on the Stoich. So momentum is pretty average with selling on the MACD. So that's interesting. So if these two could match, you could be looking at an upward trajectory back up to 700, where it has been in the past. We're looking at 738 high back in March. So what a recovery from where it was, and then it dipped back down to 520, and then now it's moved back up on an average of about 585 to 600, which I think would be a good entry point, guys. So maybe something to look at for in terms of that for Meta. We know that Meta's capex is a problem. They're spending an absolute shed loads of money at the moment, and I think investors are starting a little bit worried about whether or not they're going to get their money back. Same for Microsoft, same for Meta on my list, and that is one of the issues that we have at the moment, whether or not they get the return on that money they're spending at a large amount. They even had to borrow money recently. Also, the actual user side is slightly flatlining, going back down again. So food for thought, but still think it's a great company at a great bargain. ServiceNow, one of my favorite companies. I think one of my favorite companies, and also one of my best yet in terms of viewers when I did this analysis. Please do check it. It's again on my playlist there. Currently, at the moment, ServiceNow is actually at the moment at $98 a share, the highest it's been in almost a month. It was initially at 104, dropped back down after its latest results, lingered between 86 and 90, and then now moved back up to just south of 100 at $98 a share. So the first time. Now, I've been in and out of ServiceNow quite a few times because I wasn't sure whether or not I was buying currently always at the right price. I was quite harsh on myself in terms of my entry points. But I wish I'd bought last week, because at one stage last week it dropped to 86, and then it rose from 86 to almost $10 up. So, beauty of hindsight, this is always the way that retail investors, I'm sure, always look at this and go, oh, I wish I'd done it. But don't stew on things. There's no point. And again, really rising at the moment. Had some deals recently, which I think has boosted the share price with another big client. But a fantastic company, fantastic products in terms of, entrenched again in the financial system, a bit like Visa and Mastercard. And I think most of the biggest companies in the S&P 500 use them. Again, unfairly beaten up by their SaaS apocalypse about the replacement of the AI agent, taking seats off ServiceNow and replacing with AI agents. I think, and obviously less licenses, but I think that's absolutely not going to happen. And the fact that ServiceNow is also introducing its own AI implementation is also helping massively, and it's starting to monetize. So watch that for ServiceNow. Now, if I ever get the chance again, and this is, of maybe something falling back towards 90 to 80, 88 to 90, I will certainly buy back in. I think I've missed the boat a little bit here. As you can see from the one-day chart, at the moment, that momentum is flying, guys. Let's have a quick look at the 1 week, which gives you a truer representation. Look at that, just coming off its oversold, and that is a perfect sign. That's what you want to see if you're an investor there at the moment on the 1 week chart, which gives you a more overall and longer term look on the stock. Not a huge amount of volume on it, if I'm honest, looking at the candles, but look at this now, already 3.5% up today. So certainly some good news. Look at the news. They did just do a deal with somebody, a big company, recently, which might be worth having a look. So let's see. All, funny enough, software companies are up, including my Adobe, which we're coming to now. So great company, great software. and looking like on the up now, and I still think it's a bargain even if you do want to start looking at it. But if you're going to do it fairly quickly. Again, this is only advisory. Please do your own homework. But for me, the entry point would be more early 90s. So, least but not last, guys, Adobe. One of my old-time holdings. I've held it for nearly a year and a half, not through complete choice, if I'm honest. I've bought it a bit too early before I did the intrinsic price and before I read the value investing books, and unfortunately got caught out with a falling knife really on Adobe. Who would have thought that Adobe would drop by almost $100? A little bit unlucky in that respect, but currently an absolute bargain where it's at. So let's pull out Adobe for you guys. So as you can see here, Adobe's share price has fallen through the roof since I bought it last year. It was around the 370 mark, and it dropped back right down to 219, a 52-week low, and a pretty much beyond the 52-week low almost. It has since then slightly bounced back. Now, thankfully, the management has done a buyback, which I think was very clever, a massive amount of buybacks, which has put a floor on the ceiling of the share price. We all know that buybacks, obviously back off the market, makes obviously the share price better obviously, and people that own the share more worth more than what it is. So by buying back at that price, they've done the right thing there as far as I'm concerned, and very cleverly, because a buyback should be done when the share price is on its knees, as we know, and I've mentioned this quite a few times. So with the amount of shares taken off the market, it's certainly made the pie look more expensive, and also it's put a ceiling on the share price falling below 250 or 230 at the moment, which it has tested a few times there, as you can see, 229. It has bounced back since then. It's holding around the 248. Again, punished by, and we know that Adobe owns Firefly, editing, creative services. I used to work in the film industry. I still do, not as much now, but I did. Adobe was the main software used for editing, and has since then, again, like ServiceNow, implemented amazing AI capabilities within its editing software called Firefly, and is improving by the minute. So that should monetize eventually. So I think I'm fairly really battered by the markets, who I don't particularly think know as much as some of the people that work in a certain industry like the creative services, that Adobe is well established and will be around, as far as I'm concerned, for quite a while yet. Yes, there are some nibbling other companies like Canva that are offering services that are very good and free. I've tested it myself. Very impressive, but I don't think they are quite to the standard yet of Adobe in any way, sort of shape. And the fact that it's also very much used by the creative services, which I know is quite niche, but it also has Acrobat, which most people use, and I think it'd be very hard for it to be replaced and for its moat to be invaded or replaced as a major market shareholder. So I think as a business, it's fantastic. I think it will eventually push back up. I've got every faith in it, and I am, for clarity, losing a lot of money on this stock at the moment. So I'm looking forward to see it rise back up and make me some money at some stage, but I think it will be a while yet. Entry point, I think, would be great right now, or if you're looking at maybe really to squeeze it out, maybe do a run up at 230 to 240, and I think it will eventually pop back up, guys. So I think at this moment it is probably the most bargain out of all of them. Well over 40% discount based on the share price, and I think it's worth potentially a look at some stage. Do your due diligence. Obviously, there is a reason why it's there. Yes, there is competition. Yes, there is the AI situation, which could well at some stage replace part of the business, but I think that the fact that they've implemented their own AI capabilities will be a winner. So there you go, guys. That's Trader 72 watch list for today. Remember, great investing isn't about chasing hype. It's about buying outstanding businesses. The market will always move, but patience and discipline will always get you real winners. So very much on the intrinsic price. I think this is the all-important number you should look at. It gives you the true representation of the stock price, not the market price. And I think if you discount that off the MOS, you will get a very good idea of a safety buffer when investing. And I think that's very, very important. So let's see what happens. I'll let you know, obviously, if I do jump in any of these stocks, but that is definitely at the moment my top end watch list. Now, obviously, it can be replaced. As you will see from my share price list, there is a load of company here. I always check, but I've picked out my best so far as they stand. Usual names are in there at the moment, but most of them are so overpriced, and that is something that you guys need to be aware of. From my point of view, the market is so up and on the up at the moment that some of these companies are, as far as I'm concerned, overpriced. A lot of people will tell you to buy in and, buy, there's more potential in them. But buying on the up like this can also be quite dangerous, because if there is a market crash, which will eventually happen at some stage without sounding like the voice of doom, you could be looking at 10-20% correction, and that could really hurt. So make sure that you guys buy in, or your portfolio has a balance as well of defensive stocks, as well as tech stocks that might be undervalued, or stocks that are undervalued in a full stop. Now, the problem with defensive stocks is that they're actually themselves overvalued at the moment, because there was a fallout with what's going on with America and the Trump and the war. So some of these defensive stocks are also slightly overvalued at the moment. So pick and choose carefully. All right, let's have a quick look at the current situation now. The news at the moment, obviously, is that the war between Iran and Iran keeps going. Yes, and my short position on crude oil is very expensive at the moment, not only to keep it overnight, because obviously that is the way I basically trade, also because it's now been almost 80 days, and I thought this would be wrapped up and gone. They would have come to some kind of agreement. It seems like it's not going quite in the right direction, and I think the Strait of Hormuz is still very much closed, although there's a few ships that have gone by. Still no agreement between the two. Over the weekend, obviously, there was a drone attack against the United Arab Nations and Saudi Arabia. It was intercepted by 3 drones. So Donald Trump is now running out of patience with Iran, and it looks like we are still on a standby. The share price of crude oil is currently at 112, creeping up more than creeping down. It was at 108, 107 last week, thinking that there might be an agreement, and now it's creeped back up almost $5-6. So, obviously it's putting pressure on bonds, it's putting pressure on currencies, and it's putting pressure on inflation overall, which means that our markets currently this morning are all in the red. As you can see, Nasdaq and US 30, although this is pre-market open. It's quite a resilient market, yes, but eventually there are going to be issues with inflation and employment, I think. Back in the UK, it's a nightmare. We're having leadership contests potentially. Labour is in turmoil, our current government, for some of you who don't know, and is no better here. I did buy into an English stock, though, this morning, which I'm sure I mentioned last week, Marks and Spencer's, which is on my list. Bought it at a very cheap price. Very happy about that, because it's a top grocer in the UK. Has been in America. I still think there might still be some Marks and Spencer in America. Make comments below, but I bought it at a really good price at 314, currently at 318, and went to see it. It looks like it's now picking up some momentum, so very, very much on the 52-week low there, and I bought it at a super duper discount, really, of almost 40% discount on its intrinsic price. Plus the fact that it's a really good business. Yes, the margins are probably not as good as some of the companies I would look at in criteria, but very well established, clothing and grocery in the UK. So fantastic quality food as well. I know we buy some of it and we love it. One retail investor to another. This is Trader72. Please make comments below on my watch list. Let me know what you think. I know I keep repeating it, but I don't get enough comments. Always good to get positive and negative comments. I'm thick-skinned, so I like to see if there's people agree or not agree with me. And also, please do click, but subscribe and like, please, guys. This is really important for me, and it just enables me to continue and do this. The first one this this week. There will be a few more this week, or maybe one more, depending on how much time I've got. I'm looking, hopefully, to do further analysis on the companies, so go back to our usual format. And if you like this format of me just keeping an update on the watch list, the entry points, the share price only, not just the analysis, then let me know. All right, guys, take care. Have a great week. Speak to you soon.